Hello traders, welcome to the 8-minute currency trader special presentation called Fibonacci Trading Secrets Revealed. I'm the editor, Gregory of the 8-minute currency trader, and it's my great pleasure to be able to share with you this short video that I put together to explain how to use Fibonacci in your everyday trading. Now in this short video, what we're going to do is I'm going to tell you what is Fibonacci, and then show you how you can use Fibonacci to find entries, how to use Fibonacci to find exits for maximum profit, as well as entries and exits for minimum loss. And in addition, I'm going to show you how to take a Fibonacci failure and turn it into a big gainer. So let's go ahead and get started. Now let's look at the man behind Fibonacci, Leonardo da Pisa Fibonacci. He was a 12th century Italian mathematician, introduced Arabic Hindu number system to Europe, replacing the Roman numerals. And if you've ever used Roman numerals or had a clock or something, counting I plus I is I, it was very cumbersome. And so by introducing this Arab Hindu system of 1, 2, 3, 4, 5, 6, 7, 8, 9, and the 0, he was able to create any number by just using those 10 digits. Okay, so it brought that, but not only did he bring in the number system, guy's real smart, he also introduced the Fibonacci sequence and the golden ratio associated with that. Now he didn't create it or invent it. He studied abroad and in the Far East, and he brought that to Europe, and that's how we got our system. So let's see how Fibonacci works. So first of all, the Fibonacci is the sequence that we're talking about, is the sum of the two previous numbers starting with 0 and 1. For example, see the number 3 and 5. And if you add those two together, 3 and 5, you get 8. And then if you add the next numbers, 8 and 5, you get 13, and 13 and 8 is 21, and so on and so forth, all the way up to infinitum. And you can see through this little pattern I have here on my display, it can go pretty far. Now, what's really interesting about this particular sequence is that after you add the first few numbers in the sequence, and if you take the ratio of those two numbers, you get the 0.618, or you get that golden mean, which is called phi. For example, 34 divided by 55 equals 0.618. If you measure the ratio between the alternate numbers, you get 0.382. For example, 34 divided by 89 gives you 0.382. Now these ratios are called the golden mean. So now that we know how to find these levels, we'll now see how we can see these ratios and use them in our trading. Okay. Now you can see these Fibonacci ratios every day. You probably remember vaguely 8th grade math when they talk about Fibonacci, and maybe you were in class, and maybe you ditched, or maybe you fell asleep. Or maybe you actually paid attention and you actually use Fibonacci. But you use Fibonacci every day. You can see it in nature, in the way a sunflower seed is formed, 34, and then it alternates 89 in the other direction, and then it goes 144 in the other direction. So we see it on sunflower. The Great Pyramids of Egypt and Mexico are Fibonacci ratios. The Pantheon in Greece. The body measurements. If you take the height from your head to your belly button, and from your belly button down to your feet, it comes out to be a Fibonacci ratio. And if you take the keys on a piano, 8 white keys, 15 keys in 1 octave, and so you've got this, or 13 keys in 1 octave, and you get that Fibonacci numbers in the way a piano is set up. And also the Nautilus shell, which is a common representation of the Fibonacci, and how that growth pattern from smaller to larger loops spirals outward. And what he wrote about in his book, Fibonacci did, was to answer the question, what happens? How many rabbits will you have after after so many months of mating? And you can use Fibonacci to figure that out. Okay, so those are some of those abstract ways of using it. Now, what we want to do is find out how to make money, make tips using this particular strategy. Okay, whether you believe it's hocus pocus or universal law or whatever it is. It doesn't really matter, but a lot of traders look at it and they follow it. And so what we want to do is trade what traders are looking at, and that gives us a high probability way of finding support and resistance. And what we're using Fibonacci for is for discovering hidden levels of support and resistance. Okay. Now, since the Fibonacci sequence reflects the growth process of expansion and contraction, price action that matches this golden mean would mean more growth at or beyond to certain key ratios. For instance, let's say we had a run up here in the Australian dollar from 0.7, had been 0.7 a long time, and we rallied all the way up to 0.85. Okay, so we have a run. We can take that in the number of pips and measure that out. We can cut it in half to get the 50% retracement ratio where this could possibly come down. The first ratio would be the 23.6%, which is this first line here. Okay. The next one would be the 38% retracement, which is 38% of this move. Let's say this move was 100. Okay, that's arbitrarily to say it's from 0 to 100. Okay, well, if it pulled back 23 pips, we expect it to bounce. Either bounce there, that would be a very aggressive move, or it can pull back to a 38.2%, or pull back of 38 pips from the high. Okay, or it could pull back 50, or it could pull back 0.618 or 62 pips from the high, or it could pull back 78.6 pips from the high. Now it's going to usually price stops at one of these levels, and once it does, it bases and then goes to and then springs up, and that gives us that 1, 2, 3 breakout pattern that I talked about. Okay. Now you can see in this same example, we did pull back to this 38% retracement around the 0.776 area, and look how like little candle patterns. You see the long wicks, 1, 2, 3, 4 bearish reversal candlestick pattern at a 38% retracement of this up move. So this up move, we basically took a third of the move retracement, and then we could get long on a candle break above that consolidation, above that rectangle. Our stop can be placed just below. You can place your stop maybe below that last fib, the 0.50 fib, and then look for an extension beyond the high. The first target would be the old high, which is where this circle is, and we can look for maybe an extension target, maybe the 62% extension of that. Okay, so what the clue is that if price bounces and starts holding that area, that should give us an indication that other people are looking at that area too, and price could respond in a growth pattern to the upside. Okay, and now in a downtrend, similarly, we have this down move in the euro dollar from 143 down to 138, and let's say we missed the move and that's all we saw. Well, we know that we could have some type of a retracement. We can put our fib level, we snap our fib from the high to the low, okay, and then this will give us our 23% retracement, our 38.2% retracement, or 50% retracement, the 62 or 61.8% retracement. And if price stalls and forms some type of bearish reversal candlestick pattern at one of these levels, we look for price to drop back down, at least back to the old low, and then maybe exceed beyond that old low. So that's what we're looking for. Okay. So in uptrend, Fibonacci retracements act as a floor and act as support. Okay. And for us to go long. But in a downtrend, Fibonacci levels act as resistance, capping prices, acting as a ceiling, as hidden levels of resistance. So price will hit that ceiling and turn around. And those places where price turns around at a fib level are often the best places to enter a trade. Now, Fibonacci works best when the market is trending, okay? Fibonacci's and moving average and any type of trending indicators aren't going to be very helpful in a sideways market. We want a market that's making higher highs and higher lows, and we have some type of a trend, okay? So the idea is to go long or buy on a retracement at a Fibonacci support level when the market is upward trending, or go short or sell on a retracement at a Fibonacci resistance level when the market is trending down. So here we have our 1, 2, 3 blast off pattern. the first move we missed perhaps, and price comes down maybe to a 61% retracement of this up move, okay? And price moves sideways there, then bounces up. We want to get long and place our stop just below this low and look for an extension, okay? This 3 blast off. And then sometimes it'll continue, pull back and continue again. So we got heavy selling here, a lot of stops above that 1, and that caused that big blast off there. We have some heavy profit taking going into this level, and then we look for that extension. We do the same thing. We go from the high. This looks like a pullback, maybe a 38% retracement. We look for a bounce there. We get long on a bounce above this 4 and look for price to go up, placing our stop there. Now, if price breaks below the 4 or price breaks before the 2, that's telling you that, hey, maybe this Fibonacci thing is not working here. So there's no longer, probably not an uptrend. You probably caught some type of a bounce retracement in a downtrend. And so the idea is to go short. When the Fibonacci levels aren't working, chances are you're on the wrong side of the trade and you should be going short instead of long. Or the other way around, if you're going short at certain Fibonacci levels and price breaks to a next higher fib, you're probably on the wrong side of the trade and you need to just flip your fibs around and get long. So let's look at the 4 major Fibonacci retracement levels. There's a 23% retracement, a very aggressive move. It means that people aren't even waiting for a pullback. They're jumping in. It's a 38% retracement, which is one of the most common areas of Fibonacci retracement. That's also more aggressive. The 50%, I put a star by it because it's not really a fib level, but it's half the move. And if something moves up 100 points or 100 pips and it comes back 50, chances are people are going to try to jump back in, bargain hunters, at that 50%. So it's commonly looked at. We call it a fib level, but it's really not a Fibonacci ratio. 61.8 is considered the last Fibonacci that price comes down to. It means that the trend is weakening because people didn't buy at any of these other levels, and so maybe people, bargain hunters, are coming in, value hunters at that 618. 786, that's like the last level of last resort, and we look for price to, if it breaks through that, chances are we have a reversal and we want to switch direction. So 786, and we look for some type of an extension from this area, and we'll talk about that too. So let us go on to some live examples. Let me pull up a chart here and bring a chart, and here we go. This is the Aussie dollar, and this is a let me just go ahead and move it back here. This is where we were looking at this long wick, okay? Looking at this long wick and this long wick here to the upside. So if you can see these 2 wicks here, I'm going to put one there, okay, circle there, okay? So I saw this move, and I took my fib from the low, use my fib tool, from the low to the high, okay, and I can see that price, oh, and I'm actually in some trades, so I'm going to show our trading history, okay, and show trading orders, okay. And we can see that, oh, we have a big breakout candle. This is non-farm payroll, people. This is a very powerful move up to the upside. And we just had that break north. And the price broke to the upside and hit our limit on that trade as well. So that is how we, I'm going to measure that out. Using this fib tool, pulling it backwards gives me an extension target 107.57. It looks like where we will go, and price can go ahead and hit that area. So let's see if we there we go, and we got out on that trade. So there we go. We pull our fibs back, we hit the extension, we hit some trades. This is actually happening today. I want to thank you for joining me for this edition